All right, let's jump right into this. Welcome to the Explainer. Today, we're putting on our Chief Investment Officer hats to run an absolute masterclass in objective stock analysis. We're looking at a medical technology firm called Enovis, ticker symbol ENOV. And we aren't just glancing at stock charts here. No, we are running this company through a rigorous gauntlet of legendary investing frameworks. We're talking Warren Buffett, Peter Lynch, Benjamin Graham, plus a standard discounted cash flow and some alternative valuation models. It's going to be a deep dive.
Here's our game plan. We'll start with a quick snapshot of Enovis and apply the Buffett lens. Then we'll run the Peter Lynch assessment, calculate Benjamin Graham's value formula, build out a DCF valuation with a sensitivity table, check out some alternative valuation models, and finally, synthesize the whole thing for our final verdict. Let's get to it.
Section 1. The Enovis snapshot and the Buffett lens. Let's ground ourselves in what this business actually does and see what the Oracle of Omaha would think. Okay, so Enovis is currently trading at $21.97 a share, which gives it a market cap of about $1.43 billion. They operate in this massive $55 billion musculoskeletal market. Essentially, they blend steady cash-generating bracing and recovery products with some really high-margin reconstructive surgical innovations. And they've got some serious momentum right now. They just beat their Q1 26 revenue expectations, posting $589.2 million in sales. That's up 5.4% year over year.
But let's apply our first framework. When Warren Buffett looks at a business, the absolute first thing he looks for is an economic moat. That protective barrier around the company that keeps competitors at bay. Alongside that moat, he wants consistent earnings, a high return on equity, honest management, and critically, manageable debt.
So, the million-dollar question, would Warren Buffett buy Enovis right now at $21.97? Well, when we actually apply Buffett's incredibly strict criteria to the latest financial data, the results give us a pretty fascinating but honestly mixed picture. It's really interesting how quickly the Buffett thesis hits a brick wall here. Let's run down his checklist. Moat? We'll give that a pass. They have a really solid portfolio of specialized surgical patents. Management? Pass again. They're honest, they hit top-line guidance, and they've expanded gross margins to 62%. But then we hit the roadblocks. Consistent earnings? Major fail. The trailing GAAP EPS is negative $19.88, so historical owner earnings are just deeply in the red. Low debt? Absolute fail. Enovis is carrying a staggering $1.33 billion in debt compared to a measly $33.1 million in cash. Because of that heavy leverage and the negative owner earnings, Buffett would absolutely pass on this stock and wait for a cleaner balance sheet no matter what the margin of safety looks like.
Section 2. The Peter Lynch assessment. Let's see what happens if we look at this exact same data, but through the eyes of the legendary growth at a reasonable price investor, Peter Lynch.
Lynch was famous for categorizing companies to really understand their story, but his mathematical holy grail, that was the PEG ratio. The PEG ratio basically measures the trade-off between the price of a stock, the earnings it generates, and its expected growth. For Lynch, finding a PEG ratio under 1.0 was the dream. It meant you were scooping up growth at a genuinely undervalued price.
And this right here is exactly why a Lynch investor would be leaning in right now. Because Enovis's trailing GAAP earnings are negative, we have to use forward estimates to find our PEG. Let's walk through the math. Using a forward EPS estimate of $3.98 at that $21.97 stock price, we get a forward PE ratio of about 5.5. Now divide that 5.5 PE by the expected earnings growth rate of 9.04%, and we landed a PEG ratio of 0.61. That is a highly, highly favorable metric.
So, what's the ultimate Lynch verdict?
Well, he'd likely categorize Enovis as a turnaround story. They're transitioning from their Colfax origins into a pure-play orthopedics leader. And that 0.61 PEG ratio, that screams strong buy in his framework. But wait, Lynch also demanded a strong balance sheet to survive turnaround hiccups, and that $1.33 billion debt load is a massive red flag. Blending it all together, Lynch would probably view Enovis as a speculative buy. It's a compelling growth story at a steep discount, provided you have the stomach for that debt risk.
Moving on to Section 3, Benjamin Graham's value formula. Now we're going to subject Enovis to the uncompromising, math-heavy gauntlet of the father of value investing himself. Graham always started with a strict defensive investor checklist to protect his capital. Let's see how Enovis scores. Adequate size? Pass. At $1.43 billion, it's definitely large enough. Strong financial condition? Fail. Graham wants current assets to be double current liabilities.
And with debt towering over cash like that, Enovis misses the mark entirely. Earning stability? Fail again, thanks to those recent GAAP net losses. Dividend record? Fail. They don't even pay one. So right out of the gate, Enovis spectacularly fails Graham's defensive test. But remember, Graham was also a deep value hunter. So let's run his famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. Now, the explicit book value per share is actually missing from our source text. So to make this work, we're going to assume a conservative book value of $15 per share, which aligns with industry norms for these asset-heavy medical hardware firms. We'll stick with that forward EPS of $3.98. The square root of 22.5 times 3.98 times 15 gives us an intrinsic fair value of $36.65. So here's the kicker. Compared to the $21.97 trading price, there is a massive margin of safety here. An enterprising Graham investor might actually take a bite at these levels, despite it failing the defensive checklist.
Section 4. DCF Valuation and Sensitivity. Let's take a quick step away from the guru frameworks and build out our very own base case discounted cash flow model.
To build a DCF, we obviously need to forecast free cash flow. But here's the catch. Enovis's Q1 free cash flow was actually negative $28 million. So we're going to assume a normalized forward free cash flow build based on management's full-year guidance of $430 million in adjusted EBITDA. We're projecting this over a standard 5-year forecast. Let's apply an assumed 9% weighted average cost of capital, or WACC, as our discount rate, and use a standard 2% perpetual terminal growth rate.
When we run those assumptions through a sensitivity table, stress testing different discount rates against different growth rates, our base case scenario spits out an intrinsic value ranging from $25 to $32 per share. Think about that. Even at the absolute most conservative end of this DCF model, the math is telling us the stock is currently undervalued at $21.
Section 5. Alternative valuation models. It is always a smart move to cross-verify your DCF with comparable company analysis. Let's look at the EV to EBITDA multiple.
Okay, to find the enterprise value, we take the $1.43 billion market cap, add the $1.33 billion in debt, and subtract the $33 million in cash. That gives us an enterprise value of roughly $2.73 billion. When we divide that by the $430 million in expected adjusted EBITDA, we see that Enovis trades at just 6.3 times EV to EBITDA. To put that in perspective, standard medical technology companies typically trade closer to a 10x multiple. So this alternative model aggressively confirms what our DCF and PEG ratios were hinting at. The core operations here are priced at a very steep discount.
Section 6. Final synthesis and recommendation. Time for the master call. Let's bring all these distinct valuation lenses together into one cohesive verdict.
Stacking our models side by side paints an incredibly clear picture. The current price sits at $21.97. Buffett says wait because of the debt. Lynch says speculative buy, thanks to that 0.61 peg. The Graham formula implies a $36 fair value. Our DCF base case lands around $28.50, and the EV to EBITDA multiple suggests a price well north of $30. Literally, the math consistently suggests Enovis is significantly undervalued, provided management can actually hit those forward estimates.
Ultimately, this investment thesis hinges on a very delicate balancing act. On the optimistic side, you've got undeniable strengths. Top-line revenue beats, gross margins expanding to over 62%, and cutting-edge reconstructive products that are driving above-market growth. But weighing down the other side of that scale, you have the very real risks, a heavy $1.3 billion debt burden, and those negative trailing GAAP earnings.
Blending all these insights together, our final verdict is a speculative buy, specifically for risk-tolerant value investors. The discount is just too steep to ignore. The upside implied by the 0.61 PEG ratio and the 6.3x EV to EBITDA multiple totally outweighs the balance sheet risks. But, and this is a big but, only if management executes and hits their guided 25% free cash flow conversion rate so they can actually start paying down that debt.
So as we wrap up this explainer, I want to leave you with a provocative thought to ponder. In a massive $55 billion market, does the clinical innovation of Enovis's products outrun the heavy leverage sitting on its balance sheet? Well, if you believe it does, the math suggests this stock is an absolute bargain. Thanks for joining me today, and keep doing your own rigorous analysis.